After the gaming giant settled a bribery investigation. Good afternoon. This is Business Live with me, Ian King. The UK economy unexpectedly contracted in October as higher borrowing costs hit activity. The Office for National Statistics said that gross domestic product was estimated to have fallen by 0.3% in October, following growth of 0.2% in September. Economists had been predicting no change in GDP. The ONS said output fell in each of services, production and construction. It was the first month-on-month contraction in GDP since July. For the 3 months to the end of October, there was no growth in GDP compared with the 3 months to the end of July. The pound fell on the foreign exchange markets on the figures. Well, our economics editor, Ed Conway, has been taking a look at the numbers.
Let me just show you kind of what's just happened. These are the numbers on gross domestic product. It is the best measure of how fast the economy is growing or indeed contracting. And this is just showing you over the course of the recent months, anything that's growth is above the line, anything below is contraction. And have a look. I'm going to bring up October's numbers there. Look. You can see it's down by 0.3%. That actually was not expected. Economists thought maybe they would be kind of down by a tiny bit, minus 0.1%. An interesting thing here is just kind of breaking down these numbers. So if you look at this bar in particular, I'm going to show you the component parts, different parts of the economy that actually contributed to this. And you can see a lot of that is that blue bit, and that's services. So the services sector was down, but also production, which is basically manufacturing, that was down as well. Construction down as well. So it was a broad-based fall across the economy. Economists say, partly maybe down to weather, construction down more than expected. But also, remember, the Prime Minister Rishi Sunak has committed to trying to get the economy to grow. And it's worth just kind of working out kind of where we are on that basis. This is showing you the level of growth. And so you can see the pandemic there, everything fell and then kind of bounced back to some extent. The Prime Minister said at the start of this year that he wanted to grow the economy. So you would expect to see that line kind of going up. And have a look at where it has gone. It's essentially, it is up a bit, like a few percentage points, decimal places of a percentage point. But nonetheless, it's basically flatlining. And you really get a sense of that when you look at where the economy might have gone had it followed the pre-pandemic trend. In other words, if it carried on growing as it was before the pandemic in kind of normal times, here's where it potentially might have gone. So you see that line going up and up and up, and you see that where we are is essentially getting wider and wider away from where it might have been in the past. And it's worth just saying, in the US, those lines, that kind of non-dotted line, the line of where the economy actually is in the US, that has now gone back above the pre-pandemic trend. It hasn't in the UK, it hasn't throughout most of Europe. That's going to be the concern for the Prime Minister. Yes, maybe he's just about outgrown the economy, but when you look at these latest numbers, it's not really much growth, to be honest with you.
Some other business news stories for you now. And the chief executive of Entain, the betting and gaming group behind Ladbrokes and Coral, has stepped down with immediate effect. Jette Nygaard Andersen had been leading the business, whose other brands include Sporting Bet, bwin and Gala Bingo, for the last 3 years. Her departure comes just weeks after Entain paid a £585 million penalty to settle charges stemming from alleged bribery offences at its former Turkish unit that predated her time in charge. The UK's payments regulator has provisionally proposed a cap on cross-border interchange fees charged by MasterCard and Visa on transactions made between the UK and the EU single market. The proposal from the payment systems regulator follows the end of a review into interchange fees. Those are the fees paid by a merchant's bank to a card issuer's bank whenever a customer uses a credit or debit card to make a purchase from them. The review was launched after the UK left the EU and the EU's payment rules ceased to apply here. And the recruitment firm Impellum has agreed to a takeover by Headfirst Global, an HR services platform based in the Netherlands. Impellum, which is majority owned by the former Conservative Party Deputy Chairman Lord Ashcroft, has been in talks with Headfirst since July this year. Impellum, which employs more than 2,000 people and operates in 70 countries, is best known as the biggest supplier to the NHS of locum doctors and nurses. Now, it's not been a good year for mergers and acquisitions activity, the lifeblood, of course, of the UK's financial services industry and its legions of bankers, lawyers and other advisors. M&A volumes are down 24% from the peak seen in 2021 and the situation appears to be deteriorating. But according to my next guest, while confidence remains in short supply, there are early signs of an improvement in mood. Well, joining me now is Richard Madden. He's Chief Executive of DC Advisory. Richard, good to see you this afternoon.
Good afternoon.
You see deal volumes picking up next year?
We see them picking up next year really because they've been so depressed now. We've been in hibernation and we've been scared and lacking confidence. But we've been in hibernation with private equity, as you mentioned, and private equity is restless. And so we're beginning to see that desire to do things. It's not happening yet, but the desire is there.
So private equity is sitting there with a large amount of capital burning a hole in its pocket?
Yes, and a lot of pressure, because if you think about private equity, they're put on earth to invest in businesses, to grow businesses, and then to sell them. Their model requires that realisation of capital. And the longer they don't do that for, the more difficult it becomes for them and the more pressure they're under. So
you think it's private equity that's going to drive this? I mean, what about trade buyers? I mean, valuations in the UK for listed businesses are pretty depressed. Do you think that might bring a few trade buyers out of the woodwork?
yes, but it hasn't really happened. It's a real surprise. You would think in this market, with private equity so nervous, that trade buyers who have a strategic reason to buy something and a desire to transact would be more prevalent, but they're not. They likewise are nervous and lacking in confidence. And a lot of boards of companies are saying, I don't want you to take on anything else, just sort what we've got before you take on something new.
That doesn't really say much for British boardrooms, does it? I mean, if I think back to past downturns, you had great buccaneers like Lord Brown at BP who would sort of seize on depressed valuations and say, right, we can go for it.
Yeah, it doesn't, I'm afraid. It doesn't feel very confident. But there isn't a lot to be confident about. And these companies don't need to do anything. So, as I said, private equity need to transact. Better to do nothing and not get something wrong. Yeah, it's pretty negative, I'm afraid.
Which are the sectors that you think are most ripe for a bit of activity?
So it's interesting because if you look at what drove the peak, it was the technology sector. Because you've got this secular growth. You know that there'll be more technology in use in the future than there was in the past. And that's fallen right off a cliff. So that's been the biggest faller because people are nervous because they don't know how to value technology companies anymore. Once they do feel confident that they can value it again, I think technology will come surging back because it's a long-term bet on a long-term trend.
What I thought was interesting about your report, though, is where you see geographically activity picking up. And as ever, it's a good old USA that leads the way.
Yeah, it will be the US. I mean, I think the US are more positive, more confident than we are. They accept disappointment and failure much more quickly and then move on. We just sort of wallow in it and worry about the disappointments now and what do they mean for the future. But they're just much more positive. And with a market, with an economy that's growing, it feels highly likely that they'll come out much faster and harder than we do and probably also begin to invest over here.
You do make the interesting point, though, that animal spirits have been well and truly revived in Japan, which is not something that we'd have expected had we been having this conversation.
Yeah, I mean, revived's an interesting word. I'm not sure they've been around for a very, very long time. But they are now, because now we're in a global market. Japanese corporates are under pressure to deliver better returns for their investors. They can no longer just sit and turn the handle. And that pressure is coming from government and it's coming from international investors into Japan. And so they're beginning to look at the portfolio of the business they have and decide now is the time to sell. And that's combined with the fact that private equity looking for opportunity are saying, well, actually, Japan's a good place to deploy capital. So you've got both supply and demand really working well in the Japanese market.
And obviously it helps that the yen is at pretty depressed valuations right now.
Particularly for businesses that earn money outside Japan, because clearly if you buy something in yen and it earns in yen, it's not worth a lot and it's not worth a lot. But if you buy something in yen that makes money in dollars, then that looks a very good trade.
What about the availability, to go back to this point of trade buyers, what about the availability of capital to trade buyers? I mean, balance sheets are being pretty conservatively run by now. A lot of them have surplus capital, which they're using by and large to buy back
shares, yeah.
stock. I mean, there must be a case for some of these guys being a bit more bold.
There certainly is a case, and I think that confidence will come back, and I do think that trade ought to take advantage of it now before the private equity firms are under real pressure to transact. There seems to me to be a window.
What sort of deal size do you think is going to be most common if we do get an uptick?
So it won't be the larger deals. They'll come further out because that is not only showing a great deal of confidence, it's putting a great deal of money to work, and therefore if you get it wrong, you lose more. So I think the mid-market, call it 100 to 500 million in terms of value, is likely to be much more active than the upper end of the market, which is dismal.
All right, got to leave it there. Good to see you this afternoon. Thank you.
Thank you very much.
Bit of breaking news that we can bring you now concerning the former chief executive of BP, Bernard Looney. That news comes from our city editor, Mark Kleinman, who joins me now. Mark, what have you heard?
Yeah, this is a significant piece of news that BP has just released to the London stock market, Ian, about Bernard Looney, the chief executive of the company until September, when he resigned after it became clear that he had misled the BP board about relationships that he had had with a number of other BP employees, personal relationships. And BP has just said that Mr. Looney will forfeit actual and potential pay worth more than £32 million as a result of decisions made by the company's remuneration committee. Now, he is being made to repay a couple of £1 million in the form of cash bonuses that he's previously received, and he's also forfeiting all of the future payouts that he could have earned under various BP share plans. Now, by my reckoning, Ian, this is probably the biggest single sum that any UK company CEO will have forfeited as a result of leaving their employer under a cloud. You'll remember just a few weeks back that Dame Alison Rose, the former chief executive of NatWest, left and forfeited about £7 million it was in the end as a result of her departure over the Nigel Farage debanking row. But Bernard Looney's payoff, or rather the lack thereof, really puts that in the shade. As I say, more than £32 million that Mr. Looney is foregoing as a result of the circumstances of his departure. BP is currently on the hunt for a new chief executive to replace Mr. Looney. We won't hear more about the identity of his successor, I suspect, for another few weeks to come. But some significant news from one of Britain's biggest oil companies this afternoon.
It really is, Mark. I mean, I'm astonished at some of the numbers you've just mentioned there. I mean, BP, it seems, are really taking a very, very hardball approach with Bernard Looney. Is he going to accept this? Has he got any sort of comeback here?
Well, I mean, we were talking a few weeks ago about Dame Alison Rose, about whether she might mount a legal challenge to the terms of her payoff. In the end, she decided not to. At first glance, Ian, it's hard to see Mr. Looney accepting this. We're yet to speak to his representative, so it's not clear whether he will challenge it. I mean, just to read very quickly from the BP statement, it says that the board has concluded that in providing inaccurate and incomplete assurances in July 2022, Mr. Looney knowingly misled the board, and that this amounts to serious misconduct. So, as you say, BP's board playing hardball with its former chief executive, and it will be fascinating to see how Mr. Looney responds.
It really will. Thanks for that, Mark. Some other business news stories for you now. And shares of Tesla have fallen by more than 1.75% this afternoon after the electric car maker said it will recall more than 2 million vehicles due to autopilot steering problems. The recall follows a 2-year probe by the National Highway Traffic Safety Administration, America's car safety regulator, into crashes involving the driver assistance technology. The regulator judged that Tesla's autopilot system may not have sufficient controls in place to prevent driver misuse. The agency said that as part of its investigation, it had reviewed 956 crashes where autopilot was said to have been used. And the private equity firm Apollo Global Management is weighing a £5 billion takeover of Pension Insurance Corporation, one of the city's biggest specialist insurers. Sky City editor Mark Kleinman, you've just been hearing from him, says that Apollo is drawing up plans to submit an offer for PIC, which is owned by a consortium of investors, in coming days. PIC is one of a handful of specialist insurers which take on responsibility for large corporate pension schemes. Among those it struck deals with this year include the airline Qantas. Well, still to come here on Business Live, we'll have a look at how the markets have done this Wednesday afternoon. Don't go away.
push the protesters further back here. There's around 200 or 300 still remaining.
I'm Dan Whitehead and I'm Sky News' West of England correspondent.
This van goes onto the streets of Plymouth 7 days a week, 365 days a year.
These facilities at the moment are a lifesaver. It's all we've got.
From fishing communities to bustling cities, we spend every day reporting from across the region, hearing from people who have real stories.
I'm gonna have nowhere to live for about 3 or 4 months.
There are still people inside the properties here.
They're coming from the epicentre of what is now a global health pandemic. We were seeing and speaking to young women who were selling themselves right on the high street. It was desperately sad, and the fact it was happening right in the heart of this community. Before Brexit, these oysters were being exported to the EU, but the trade stopped overnight.
What's your feeling about the future then?
Bleak. Might all be finished, I don't know.
The 5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. It's like Emirates, it's like better.
Well, the pound fell on those disappointing GDP figures that came out first thing this morning. Sterling currently off by around 0.25% against both the US dollar and the euro. They are all eyes now on tonight's US interest rate decision. The dollar more or less unchanged against the single currency. On the equity markets, this is how Europe's finished. All the main continental European indices in negative territory. Slight surprise to see Madrid lower because features today include Inditex, the owner of Zara, which hit an all-time high today in Madrid after raising its full-year profit forecasts. Here in London, the FTSE 100 has just about kept its head above water. That's helped out by some of the big dollar earners, which always benefit when the pound falls against the greenback. In percentage terms, the leading gainer is Entain. The departure of its chief executive has apparently been quite well received. The shares were up 4% a little earlier on. Well, the specialty chemicals group Croda has attracted support from one of the brokers today. Its shares up 1.25% at the close. To the downside, B&M European Retail is off by 6.25%. That's after the founding Aurora family sold a 2.8% stake in the company. Outside the FTSE, the ventilation product supply Volution. We had the chief executive on the programme fairly recently. They're up 4% on a trading update, while the aerospace and defence contractor Chemring has rallied 3% following yesterday's results-driven sell-off. Over on Wall Street, all of the main equity indices have again opened to the upside. That, of course, is ahead of the Federal Reserve's final policy decision of the year later on this evening. Talking points include Pfizer. Shares off there 8.25%. That's after it warned that full-year sales could be below Wall Street expectations this year by as much as $5 billion. As for the oil price, well, it's rallied after yesterday's sell-off, but it remains close to a 6-month low. A barrel of Brent crude will currently cost you $74.28 a barrel. That's up just shy of 1.5% on the session. Well, joining me now is Lucy Coates, Investment Director, of course, at JM Fin. Lucy, good to see you this afternoon. We just broke that news about Bernard Looney potentially missing out on £32 million worth of shares and payments. I mean, an extraordinary sum of money.
Extraordinary indeed. And whether he will actually take a case back and put a defence in for that decision, I don't know. But, you know, these chief executives do get vast rewards built into contracts. That's what he's entitled to. So it will be interesting to see what defence he puts up.
What I'm amazed by is that quite often you see boards rolling over and paying out decent sums to a CEO who they parted company with fairly tersely. But the BP board is really playing it very tough here.
They are, and I think there has to be some public sentiment behind that decision. I mean, it wouldn't go down well with the public. I don't think it would go down well with shareholders. There is a reason why you had to step back. So, you know, obviously, the legals will take that forward either way. But, yes, I mean, BP's making a stance.
Interesting to watch. And obviously, the big story today was the GDP figures, well shy of expectations. I mean, I've mentioned how sterling performed, but it was the gilt market that caught your eye.
Yeah, so the 10-year gilt, which is what financial markets really look at to where the future of interest rates is going to be. And so we've seen that gilt yield sort of come down. So that means, inversely, the price has moved up. So the buyer's buying the gilt market. And that means they're locking into that interest rate. So they're now below 4%. It's only in August they were touching 5%. So we've seen big moves in the gilt market.
Yeah, very good news this for the government, perversely.
Perversely, you're absolutely right. And I mean, I think what we're probably seeing with the GDP numbers, as you rightly said earlier in the piece, you know, we've had 3 months of zero growth. And when you get the numbers through, that's on a sort of lagged effect. So I think by the time we get numbers in January and February, what we might actually see is that we are currently in recession. But we're probably, by the time we get those numbers through, we're going to probably be out of it again.
Yes.
So, and we're seeing, yeah, we are a service industry, and it's the services bit that's holding that down, and we're still 5% below pandemic levels. So there's a lot of recovery to come.
Yeah, very depressing news just before Christmas, that.
Yes, sorry about that.
No, well, you've made the call, and a very bold one it is too, Lucy. And now, a big corporate story that's caught a lot of the people's eye today. Boots potentially coming back to the London stock market.
Yeah, so Boots left us. It was taken private in 2007. It was the only or the first FTSE 100 company to do that. It went for 10.7 billion, and last month it was able to offload its pension scheme, which was worth 4.8 million. I think L&G picked that up. Higher interest rates make that much more attractive asset, hence why they're able to offload it. But what we're now seeing is that probably it's being positioned for either a sale or it's possibly going to have an IPO in London, and the rumours are at 7 billion. So it'll be happy to see it back in the domestic market, and we'll see what happens.
It really will be, won't it? Because, I mean, obviously this has been such a depressing year for IPOs in London. I mean, this could really bring back a bit of confidence.
It could, because we've seen the likes of CRH go, you know, Arm is listed in the US, you know, sort of Ferguson. There are numerous companies now who've gone to the US claiming that it's a more liquid market. It sort of offers more growth, and valuations are acceptably higher. Here in the UK, companies are valued lower, so it's less attractive. But for Boots, it is a domestic brand, so it would make more sense for it to list in London, and it would be good news to see it back.
It would be. A lot of people would easy to get their head around Boots, wouldn't it? Lucy, good to see you.
Good to see you, thank you.
That's it from me. I'm back again with our next edition tomorrow morning at 11:30. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this very short break, it's Mark Austin with the News Hour. Cheerio.
The 5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.